For most of the last century, economic growth has been treated as a synonym for progress. When GDP goes up, politicians celebrate, markets rally, and headlines announce that the economy is strong. Growth is presented as proof that society is moving forward, that living standards are improving, and that the system is working. Yet for a growing number of people, this story no longer matches lived reality. The economy is supposedly expanding, but housing feels unreachable, savings feel fragile, and everyday life feels tighter, not freer. This gap between official growth and personal experience is not a coincidence. It is the central contradiction of the modern economy. GDP at its core is a simple accounting number. It measures the total monetary value of goods and services exchanged in an economy over a period of time. It does not measure well-being, security, or prosperity. It does not ask whether people can afford homes, raise families, or retire with dignity. It simply counts spending. If more money changes hands, GDP rises. If less does, it falls. That simplicity made GDP useful after World War II, when economies were rebuilding from physical destruction. More factories, more roads, more houses genuinely meant better lives. Production and prosperity moved together. Growth was tangible. But over time, GDP became something else. It turned from a rough indicator into an unquestioned goal. Governments optimized for the number, not for what the number was supposed to represent. As long as GDP increased, deeper questions were ignored. Who benefits from this growth? Who pays for it? And does it actually make life better for the average person? Consider housing. In many developed economies, GDP has steadily increased for decades. Yet, home ownership rates among younger generations have fallen. In the United States, median home prices have risen far faster than median incomes since the 1980s. The same pattern appears in Canada, the UK, Australia, and much of Europe. GDP growth coexists with a reality where people spend a larger share of their income just to secure shelter. From the perspective of GDP, rising house prices look like success. More money flows through the economy. From the perspective of households, it means permanent insecurity. The same contradiction appears in work. Official data shows growing economies, yet many workers feel trapped. Real wages, adjusted for inflation, have stagnated in large parts of the developed world since the late 1990s. People work longer hours, take on side jobs, and remain constantly connected to work just to maintain a standard of living their parents achieved with less effort. GDP records all this activity as growth. It does not record exhaustion, stress, or the loss of time. Healthcare offers another example. When medical costs rise, GDP increases. More spending on insurance premiums, procedures, and pharmaceuticals all count as economic output. But higher healthcare spending does not necessarily mean a healthier population. In fact, in some countries it reflects inefficiency, administrative bloat, and rent extraction. People pay more to get the same or worse outcomes, while GDP proudly registers progress. This is the first illusion of modern growth. GDP rises when costs rise. If rent doubles, GDP goes up. If tuition doubles, GDP goes up. If energy prices spike, GDP goes up. From the accounting perspective, the economy is doing better. From the human perspective, life is becoming more expensive. The number improves while the experience deteriorates. Historically, growth implied abundance. Today, growth often coincides with scarcity. Scarcity of affordable housing. Scarcity of stable employment. Scarcity of time. The economy produces more transactions, but not necessarily more security. This is why people can live in a growing economy and still feel poor year after year. The generational divide makes this especially clear. Older generations accumulated assets during periods when prices were low relative to income. Younger generations enter an economy where assets are expensive, debt is normalized, and risk is pushed downward. GDP growth does not distinguish between these experiences. Rising stock markets lift the wealth of those who already own stocks. Rising real estate prices enrich property owners. GDP captures the aggregate, not the distribution. A small group can gain enormously while the majority falls behind, and the headline number will still look healthy. This disconnect has consequences beyond economics. When people are told the economy is strong, but feel personally insecure, trust erodes. Institutions lose credibility. Official narratives sound increasingly hollow. Growth becomes something that happens on screens and spreadsheets, not in daily life. People stop believing in the promise that if they work hard and play by the rules, the system will reward them. The problem is not that GDP is wrong in a technical sense. The problem is that it is incomplete, yet treated as complete. It measures activity, not outcomes. It measures motion, not direction. A car accelerating toward a wall is still accelerating. GDP cannot tell the difference between productive progress and destructive momentum. By focusing on GDP alone, societies have learned to confuse busyness with improvement. More transactions, more debt, more financial complexity all inflate the number, but they do not guarantee better lives. In fact, they often mask deterioration. When people must spend more just to stand still, GDP growth becomes a statistical illusion, not a social achievement. This is why the phrase "the economy is growing increasingly" rings false. Growth exists, but it is abstracted away from human experience. It benefits balance sheets before households. It rewards ownership over labor. It prioritizes scale over sustainability. And it demands constant expansion, even when the foundation underneath is weakening. We are told that growth is proof of success. But success for whom? If the economy expands while the majority feels poorer, less secure, and more anxious, then growth has lost its meaning. It has become a number detached from purpose. And until that contradiction is confronted, GDP will continue to rise, even as everyday life quietly shrinks. Modern economic growth did not become hollow by accident. It changed because the engine behind it changed. In the decades after World War II, growth was driven primarily by productivity, new factories, new technologies, better infrastructure, and rising output per worker. Today, much of what is labeled growth comes from a very different source. It comes from debt, not debt as a temporary tool, but debt as a permanent structural necessity. To understand this, it helps to look at how GDP is actually constructed. In simplified form, GDP equals consumption, investment, government spending, and net exports. Each of these components can rise either because an economy becomes more productive or because it borrows more. Over the last 40 years, borrowing has increasingly done the heavy lifting. Households borrow to consume. Corporations borrow to buy back shares. Governments borrow to fund deficits. The spending shows up immediately in GDP. The obligation to repay it does not. This creates the appearance of growth without the substance. When a government runs a deficit, it injects demand into the economy. Roads get built, programs get funded, salaries get paid. GDP rises. But unless that spending leads to lasting productivity gains, the economy has not become stronger. It has simply shifted future income into the present. The bill is postponed, not erased. The scale of this shift is historically unprecedented. In many advanced economies, total debt, government, corporate, and household combined now exceeds 3 times GDP. Decades ago, such ratios were associated with financial crises, not normal functioning. Yet today they are treated as stable, even healthy. Growth has become dependent on ever-increasing leverage. If borrowing slows, growth falters. If borrowing stops, recession follows. Household debt illustrates this clearly. In earlier periods, rising incomes allowed consumption to increase without heavy reliance on credit. Today, consumption growth often depends on loans. Mortgages stretch further relative to income. Credit cards fill the gap between wages and living costs. Student loans delay adulthood while inflating GDP through tuition spending. Each transaction counts as growth, even though it reduces future financial freedom. Corporate behavior tells a similar story. Rather than investing heavily in new productive capacity, many firms use cheap debt to buy back their own shares. Buybacks raise stock prices, enrich shareholders, and boost financial sector activity. They also contribute to GDP through fees, trading, and compensation. But they do not increase the economy's ability to produce goods or services. Debt replaces innovation as the driver of growth. Government spending completes the picture. Persistent deficits have become the norm, not the exception. During crises, borrowing is justified as emergency support. But even during expansions, deficits remain. Growth now assumes constant fiscal stimulation. The economy no longer grows, it is kept growing. Without new debt, the system reveals how weak its underlying momentum has become. This dependence creates a dangerous feedback loop. Debt-funded spending raises GDP, which justifies more borrowing. Rising GDP makes debt ratios look manageable, at least temporarily. Low interest rates encourage even more leverage. Over time, the economy becomes less resilient. Small shocks require large interventions. Large shocks require extraordinary measures. Each cycle leaves the system more fragile than before. Crucially, debt-driven growth redistributes risk downward. Governments can roll over debt. Large corporations can refinance. Asset owners benefit from rising prices fueled by cheap credit. Wage earners, by contrast, face higher living costs without corresponding income growth. They are told the economy is expanding, yet their personal balance sheets deteriorate. From a GDP perspective, this looks like success. Spending is high. Financial activity is intense. Credit flows smoothly. But from a structural perspective, it resembles decay. Productivity growth slows. Real wages stagnate. The economy becomes addicted to stimulus. Like a patient kept awake by caffeine, it appears energetic while growing weaker underneath. This is why each dollar of new growth now requires more debt than the last. The return on borrowing has diminished. Early debt financed highways, electrification, mass education. Later debt financed consumption. Today, much of it finances asset inflation and financial engineering. The productivity payoff shrinks, but the obligation remains. When debt replaces productivity, growth loses its self-sustaining quality. It must be constantly fed. And when feeding it becomes politically or financially impossible, the illusion collapses. Growth reverses, debts remain, and the costs fall on those least able to bear them. This is the uncomfortable truth behind modern GDP numbers. They are not lying, but they are misleading. They show motion, not health. They reflect borrowed time, not earned progress. The economy looks bigger on paper, even as its capacity to support real living standards erodes. Debt makes GDP look alive, even when the underlying economy is dying. And as long as growth is measured without asking how it is achieved, societies will continue to mistake leverage for prosperity and fragility for strength. If debt is the fuel of modern growth, asset inflation is a visible flame. Over the past several decades, the most consistent source of economic success has not been an explosion in real output, but a steady rise in the price of assets. Stocks, bonds, and real estate have all appreciated far faster than wages or productivity. This divergence sits at the heart of the growth illusion. To understand why, it is necessary to separate two very different concepts that GDP quietly blends together. One is real productivity growth, producing more goods and services with the same amount of labor and resources. The other is asset price growth, paying more for claims on existing assets. The first expands the economic pie. The second reshuffles and inflates it. Modern growth increasingly depends on the latter. Central banks play a critical role in this shift. When growth slows or crises emerge, interest rates are cut and liquidity is injected into the financial system. The explicit goal is to stimulate demand. The immediate effect, however, is to raise asset prices. Lower discount rates make future cash flows more valuable on paper. Investors move into stocks, bonds, and property. Prices rise, balance sheets look stronger, and confidence returns. GDP benefits through increased financial activity, construction, and consumption by those who feel wealthier. But higher asset prices do not mean higher productive capacity. When a house doubles in price, no new shelter has been created. When stock markets surge, factories do not automatically become more efficient. What changes is ownership valuation, not output. Yet GDP treats the transactions surrounding these price increases as genuine growth. The financial sector amplifies this effect. Trading, Asset management and speculative investment all count as economic activity. As markets become more active, GDP rises. But much of this activity is circular. Money moves faster, not further. Value is extracted through fees and spreads, not created through innovation. The economy looks dynamic while becoming increasingly financialized. Real productivity growth, meanwhile, has slowed. Output per worker in many advanced economies has grown at a fraction of its post-war pace. Technological advances exist, but their gains are unevenly distributed and often captured by capital rather than labor. Productivity improvements that do occur are frequently used to cut costs or reduce headcount, not to raise wages. The link between working harder or smarter and living better weakens. Asset inflation disguises the slowdown. Rising stock markets create the impression of national success. Headlines celebrate new highs, retirement accounts look healthier, and policymakers point to strong fundamentals. But this prosperity is conditional. It depends on continued low interest rates and expanding balance sheets. It is not grounded in rising productive capacity. The distributional effects are profound. Asset owners benefit directly from price appreciation. Those who own homes see their paper wealth rise. Those with significant investments gain from market rallies. For everyone else, asset inflation becomes a barrier. Higher house prices mean larger mortgages and longer debt servitude. Higher stock valuations make ownership harder to attain. The same forces that enrich one group exclude another. GDP does not capture this divergence. It aggregates gains and losses into a single figure. Rising rents and rising home prices both increase GDP. The fact that one transfers wealth from tenants to landlords is irrelevant to the statistic. Growth appears neutral, even as inequality deepens. The result is an economy that grows by repricing rather than producing. Existing assets are leveraged, refinanced, and traded at ever higher valuations. New entrants must borrow more to participate. The system becomes increasingly sensitive to interest rates and financial conditions. Small policy changes can trigger large market reactions because so much growth rests on asset prices rather than real output. This dynamic also changes political priorities. Protecting asset values becomes synonymous with protecting the economy. Market declines are treated as emergencies, while stagnant wages are normalized. Stability is defined as preventing asset deflation, even if that means tolerating high living costs and low mobility. Growth is preserved, but its benefits narrow. Over time, the economy drifts away from its productive roots. Capital flows toward assets that appreciate, not toward investments that increase long-term output. Financial engineering outperforms manufacturing. Rent-seeking outcompetes risk-taking. GDP continues to rise, but the foundation underneath it becomes increasingly hollow. This is why modern growth feels so detached from everyday experience. It is real on balance sheets, but abstract in life. It rewards those who already own claims on the economy, while demanding more from those who do not. The economy is not producing more. It is repricing what already exists. When asset inflation is mistaken for prosperity, societies celebrate numbers while ignoring substance. Growth becomes something that happens to prices, not to people. And as long as GDP cannot distinguish between these two, it will continue to tell a comforting story that hides an uncomfortable reality. When growth is driven by debt and expressed through asset inflation, the final outcome is not shared prosperity, but quiet impoverishment for large parts of society. The economy expands on paper, while the lived economy contracts. This is how people end up growing poorer in a growing economy. The winners of this system are easy to identify. Asset owners benefit from rising prices that require little additional effort. Financial institutions earn fees from managing, trading, and leveraging those assets. Governments gain the ability to borrow and spend without immediate political cost. Each group is insulated from the fragility beneath the surface. Growth protects them first. The losers are less visible in the data, but more numerous in reality. Wage earners face higher costs without proportional income gains. Younger generations enter adulthood already behind, burdened by student debt, inflated housing markets, and precarious employment. Middle-class households discover that stability now requires constant financial optimization, not just steady work. None of this registers as economic decline in GDP terms. GDP growth has thus become a political shield. As long as the number rises, policymakers can claim success. Structural problems are reframed as personal failures or temporary adjustments. If people struggle, they are told to retrain, relocate, or wait for the benefits of growth to trickle down. The aggregate metric absolves the system of responsibility for individual outcomes. This framing changes the relationship between citizens and the economy. Instead of the economy serving human needs, humans are expected to serve the economy's growth targets. Long working hours, high mobility, and permanent insecurity are normalized as necessary sacrifices. Growth becomes a moral justification rather than an empirical description. The danger lies not only in inequality, but in misdiagnosis. When stagnation in living standards is blamed on insufficient growth, the prescribed solution is always more the same: more borrowing, lower rates, higher asset prices. Each cycle deepens the underlying imbalance. Each rescue entrenches a dependence on financial expansion. The system survives, but at the cost of its social foundation. True prosperity is not measured by how large an economy becomes, but by how well it supports human life. An economy that grows while people feel poorer is not successful. It is extractive. It takes time, security, and opportunity from the many to sustain valuations for the few. Growth, in this context, is not a sign of health, but a symptom of distortion. The myth of economic growth persists because it is convenient. It compresses complex realities into a single, reassuring figure. It allows institutions to claim progress without addressing distribution, sustainability, or meaning. But myths lose power when they no longer explain experience. And for millions, the experience is clear. Despite constant growth, life feels more constrained. The future challenge is not to abandon growth entirely, but to redefine it. Growth rooted in productivity, resilience, and broad-based gains tells a different story than growth fueled by leverage and inflation. One expands possibilities. The other narrows them while pretending to do the opposite. Until that distinction is made, GDP will continue to rise as living standards quietly erode. The economy will look stronger as people feel weaker. And society will remain trapped in a paradox where progress is celebrated in numbers, even as it disappears from daily life. This is not prosperity. It is accounting growth masking human decline.